Your employer has a life insurance policy on you right now. You never signed it. You probably do not know it exists. If you die on their payroll, the death benefit goes to the company, not to your spouse, not to your children, to the corporation. This was not a scheme confined to one bad actor. It was standard practice at hundreds of American corporations. Walmart did it, Disney did it, Procter & Gamble did it, AT&T did it. Bank of America held more of this product than almost any other institution. The people covered by these policies were not executives. They were janitors, cashiers, warehouse workers, call center employees, people earning minimum wage on a Tuesday afternoon. The insurance industry had a nickname for this arrangement. They did not call it corporate-owned life insurance. They called it dead peasant insurance. That phrase appeared in actual internal memos, documents sent between executives and their advisors. For 2 decades, the practice was completely and unambiguously legal. In some forms, it remains legal today. Life insurance as a corporate tool goes back further than most people realize. The earliest recorded corporate life insurance policies in the United States date to the 1800s, but the logic in those early years was narrow and defensible. A company founder dies without warning, and the business may not survive the transition. A lead engineer holds the only working knowledge of a critical process. This was called key man insurance. The company was the beneficiary because the company bore the risk of losing them. This model remained largely stable for a century. It was not controversial. It was not secret. What companies did with it next, no one inside the industry advertised. In 1982, Congress passed a package of tax changes. One provision made corporate-owned life insurance significantly more attractive as a tax shelter. The structure worked like this. A company identifies an employee. The company takes out a life insurance policy on that employee. The company is both the premium payer and the named beneficiary. The policy accumulates a cash value over time. Tax-deferred growth on one end, tax-deductible borrowing in the middle, tax-free death benefit at the end. For a large corporation covering thousands of employees, the math compounded quickly. Consultants began marketing the concept to major corporations in the early 1980s. The pitch was not about protecting against the loss of critical personnel. The pitch was about sheltering income, building a tax-advantaged asset on the balance sheet, turning the statistical certainty of employee deaths into a predictable revenue stream. The people who would die were not named in the pitch decks. They were described as lives covered, sometimes as employee units. Each unit carried an expected actuarial value. Each unit's death would produce a specific expected return on premium investment. The fact that each unit was a person with a family was not a relevant variable. And that was just the beginning. The original push was toward volume. Key man insurance covered 10 or 20 irreplaceable people at a major corporation. Broad-based coverage worked entirely differently. The value was in the mass. A warehouse with 400 workers contained 400 insurable lives. The company's consultants ran statistical simulations. How many of those 400 workers would die in the next 5 years? The next 10? The next 20? Actuarial tables gave precise probability distributions. A 30-year-old warehouse worker had a known statistical chance of dying before 65. The consultant knew that number. The underwriter priced the premium around that number. They bought it because the tax benefits accrued immediately. The death benefit might be decades away. The employees showed up to work the next day. They had no knowledge of being part of a financial instrument. They might work there for 5 more years, or 15, or 30. Corporate-owned life insurance policies typically remained in force after an employee left. An employee who quit in 1994 might still have an active policy in 2010. When they eventually died, the company would collect. The former employee's family would receive nothing and know nothing. That was not the end of the arrangement. Walmart became the most visible example of dead peasant insurance. In the late 1980s, Walmart began a systematic program. The goal was to insure as many employees as possible. The program was about building a tax-deferred asset portfolio. The final count of Walmart employees covered has been reported at more than 350,000 individuals. Cashiers, stockers, greeters, maintenance workers, people earning $7 or $8 an hour. Inside the company's financial planning documents, the program had an informal name, not the official regulatory designation. The name used in planning discussions between the financial team and its advisors. The name was dead peasant. That phrase appeared in memos, in internal spreadsheets, in communications between the financial team and outside consultants. It was not irony. It was not gallows humour. It was a working term for a working program. But what the memos described was something most people had never imagined. Shirley Tomlinson worked for Walmart for years. She worked as a cashier. She was reliable. She came in when scheduled. She did her job well. She had a family. She got sick. She died. Her daughter began dealing with her affairs. There was a life insurance policy. The family had known about this one. It paid a modest amount to her surviving relatives. A second policy existed. A policy Shirley Tomlinson had never signed. A policy she had never seen. A policy whose beneficiary was not her family. When Shirley Tomlinson died, Walmart received approximately $64,000. Her daughter found out years later through a lawsuit filed by a Florida attorney. The attorney had been researching corporate-owned life insurance practices. He found documents from the program. He found the memos with the phrase dead peasant. He filed suit on behalf of multiple families in identical situations. The families asked for the benefit money. They argued the policies should not have existed without their consent. The courts disagreed. The law, as it existed, was clear. The company had followed the law. The families had no legal claim to the benefit. Shirley Tomlinson's daughter did not receive any of the $64,000. But Walmart was not the only one. Not even close. What the full picture looked like, no outsider had been told. Disney held corporate-owned life insurance policies on workers at its theme parks. Not on executives. Not on creative directors. On the people who operated the rides. The people dressed as cartoon characters walking through the park. The people who cleaned the guest areas at the end of each night. Each of those workers was a line item in a coverage portfolio. Procter & Gamble held policies on factory floor workers. AT&T held them on customer service representatives. Pitney Bowes held them on mailroom staff. These were not small side arrangements. These were deliberate, structured programs managed by dedicated internal teams. Standard actuarial tables. Standard policy structures. Standard memo language that avoided using the phrase dead peasant in client-facing documents. The insurance companies that wrote the policies were not passive participants. The insurance companies marketed directly to corporate clients. They produced brochures and pitch materials. They organized seminars where corporate financial officers could learn best practices. The entire ecosystem operated in plain sight of the financial and insurance industries, and almost entirely invisible to the workers whose lives were being insured. But something else had already started moving. The banking sector took corporate-owned life insurance further than any other industry. Banks held life insurance policies as capital reserve instruments. Under certain banking regulations, core cash value counted toward capital ratios. This created an incentive that had nothing to do with tax sheltering. By the middle of the 2000s, JP Morgan Chase held several $billion in COLI assets. Wells Fargo held several billion more. Bank of America's position was the largest of any financial institution in the United States. The bank held more than $17 billion in COLI cash value. These policies covered employees at every level of the bank's operations. Tellers, processing staff, back office employees who sorted documents and managed account records. People whose deaths triggered tax-free payments into the bank's operating accounts. When those employees died, the bank did not inform the family. There was no legal requirement. When those employees left the bank, the policies often remained in force. The bank kept paying premiums. The former employee eventually died. The bank collected. The bank's CORI recovery from a former employee's death might have been substantial. That asymmetry was not accidental. It was engineered into the structure from the beginning. That was the gap that nobody inside the industry discussed. Before any policy could be written on an employee, an underwriter had to price it. The underwriter collected age, occupation category, health status from available employer records, geographic region, because mortality rates vary by location, employment tenure, because long tenure workers were more valuable to the program. The underwriter fed this data into actuarial tables. The tables produced two numbers: expected date of death, expected death benefit in net present value. The company compared those numbers against the premium cost. If the expected benefit exceeded the premium cost, the policy was written. If not, the employee was skipped. This means that some employees were selected for coverage and some were not. The selection had nothing to do with job performance. The company was not evaluating whether the employee was good at their job. It was evaluating whether their death would be profitable. Most employees never found out about any of this. The ones who did found out too late. Some found out only after a family member died, and only because of an accident. A woman in Texas named Sandra Stillman lost her husband in a workplace accident. He had worked at a chemical plant for 11 years. She filed for his life insurance policy, the one she had always known about. What she found next had not been in any paperwork she had ever seen. While going through his papers with an attorney, they found a second document. That document was not her policy. It was a corporate-owned policy she had never seen. Her husband's employer had held a policy on him for years. The money had already been paid to the company. Nobody had called. Nobody had written. The check had gone to accounts receivable. She sued. Her case was one of dozens filed in the late 1990s. Most of them were dismissed. The courts found no legal basis for the family to claim the benefit. The company had followed the rules. There was no law requiring notification. There was no law requiring the company to share any portion with the family. The policy was a legal contract between the company and the insurer. The employee was the insured life. The employee was not the beneficiary. Those are two very different positions. An insured life is the person the policy tracks. A beneficiary is the person who collects. You can be the insured life in a policy you have never heard of. There is no legal requirement that you know. There is no requirement that you consent. Through most of this period, there was no requirement at all. You were a number in someone else's actuarial table. You could live and die without ever knowing the policy existed. And then someone started asking questions. The Internal Revenue Service was not watching the dead peasant programs in the 1980s. That changed in the mid-1990s. Not because a widow complained. Not because an employee lawyer filed a tip. The IRS began looking because the aggregate numbers had become impossible to ignore. The amount of CORI outstanding was generating tax sheltering on a massive scale. The IRS began challenging specific policy structures. The key challenge involved interest deductions. Companies were borrowing against CORI cash value and deducting the interest as a business expense. The IRS argued this was circular. Some programs became significantly less profitable overnight. Companies restructured. The era of maximum dead peasant profitability was beginning to contract. Not because of the widows, because of the tax math. The widows and families who had lost court cases were still talking. Their stories reached journalists. Investigative pieces appeared in the Wall Street Journal in the early 2000s. The Houston Chronicle ran a series in 2002. The series was called Getting Rich Off Workers' Deaths. That headline moved people. Congressional officers began receiving calls. Representative Gene Green of Texas was among the first to push for legislation. Senator Jeff Bingaman of New Mexico introduced companion measures in the Senate. The bills were simple. Before any policy could be written on an employee, the employee would need to be told. The employee would need to consent in writing. When the employee died and the benefit was paid, the family would be notified. That was the ask. But the lobbying machine was already moving. The life insurance lobby opposed the bill. The corporate lobby opposed the bill. Their argument was economic. The notification requirement would destroy the programs. Employees would refuse consent. The tax shelter would collapse. They used the pension argument deliberately. Bingaman introduced versions of his notification bill 3 times. Green introduced his bill multiple times. Each time the lobbying effort absorbed the momentum. Each time the bills died in committee. Each time the families who testified sat in the audience. Each time they went home with nothing changed. But the stories were already spreading far beyond the courtrooms. The Pension Protection Act of 2006 was a broad piece of legislation addressing retirement security. Corporate-owned life insurance reform was included as a section. The provision required 3 things before any new policy could be written. The employee had to be notified that the policy existed. The employee had to be told the company would be the beneficiary. The employee had to provide written consent. For the first time, American law required that employees know about the policy. The life insurance industry's lobbying had extracted one major concession. The requirement applied only to policies issued after the Act's effective date. Any policy already in force was grandfathered. The vast majority of the dead peasant programs were already in place. Policies written in 1988, in 1993, in 2001, all of them remained exactly as before. The 2006 Act stopped the next generation of unauthorized policies. It did not address the existing generation at all. Those policies from the 1980s and 1990s are still active. When those employees died, the death benefits flowed. Not to families, to companies. A Walmart cashier enrolled in 1991 at age 25 is 60 years old today. That policy is almost certainly still in force. The IRS estimated CORI face value exceeded $150 billion by the early 2010s. That number includes both post-2006 consented policies and pre-2006 programs. They exist somewhere in the balance sheet notes of thousands of American corporations, labeled as life insurance assets, waiting. Outside the United States, corporate-owned life insurance exists in varying forms. The United Kingdom allows employer-owned life insurance under stricter disclosure conditions. Japan has a long tradition of corporate group life insurance. Australia introduced stronger disclosure requirements in the late 2000s. Canadian provinces have inconsistent rules. In Europe, GDPR created an indirect barrier. The Dead Peasant program has a European variant. It is quieter than the American version. It is not gone. Now consider the math one more time, not the historical math. The math running right now in some HR system you have never seen. Every large employer with more than a few hundred employees carries some form of this exposure. Some hold legacy CORI policies from before 2006. But the old ones are still there, somewhere in a file, attached to your name. Here is the specific thing that stays with you after reading through all of this. Not the legal history, not the tax structure, the spreadsheet. Before the company decided to write a policy on any individual worker, someone opened a spreadsheet. They entered your age, your occupation code, the actuarial mortality rate for your demographic profile, the expected number of years you would remain employed, the expected death benefit in net present value, the cost of the premium over your expected tenure, the net return to the company on your death. That spreadsheet produced a single number, the expected financial value of your death to the corporation. That number determined whether the policy was written. If the number was positive, you were covered. If the number was negative, you were not. That selection was invisible to everyone it affected. Your manager did not know. Your human resources file did not mention it. You received no copy, no notice, no notification. You showed up on your first day, you got your badge, you learned the schedule. Somewhere in a filing system, a calculation had already been made. It would follow you for the rest of your career. 28-year-old warehouse worker expected to die at 72. That worker was worth roughly $40,000 to the company. A 45-year-old mid-level manager expected to die at 74 was worth roughly $110,000. A 35-year-old call center employee was worth approximately $55,000. These numbers varied by company and underwriter. The shape of the calculation was the same everywhere. The company knew what you were worth dead before you ever introduced yourself to a colleague. Before you learned the coffee machine's location. Before you sat through a single meeting. The company had a financial position in your eventual death. That is the sentence that no legal argument ever touched. The corporations that ran these programs were not populated by people who wished their workers harm. That is important to say clearly. The executives who approved these programs were following legal strategies designed by financial professionals. They were operating within a regulatory framework that explicitly permitted what they were doing. Institutional logic says this. If it is legal and it generates return, pursue it. There is no column in the spreadsheet for how the employee would feel. There is no checkbox for whether the worker knew. The logic runs on numbers it can see. It cannot see what the employee knew or did not know. It does not try. One account makes that clearer than any legal brief can. Shirley Tomlinson's daughter has spoken publicly about what it felt like to learn about the policy. She said the money did not hurt her as much as the phrase, dead peasant. She said that phrase told her something specific about how her mother had been categorized. Not as an employee with tenure and a file and a name, as a member of a class of people whose deaths could be aggregated for profit. She said she understood that no one at the company had wished her mother dead. She said the worst part was simple. The system did not require cruelty to reach that result. The system reached it through normal financial planning, through a meeting, a spreadsheet, a consultant's recommendation, a signature. That was the whole transaction. That is the part that sits with you when you read through all of this, not the exception. The routine. The whole structure operated routinely, professionally, quietly, for 2 decades. And the people inside it moved through their days without thinking about it much at all. Because you do not think about the column marked death benefit on a Tuesday afternoon. You move on to the next item on the agenda. Somewhere in that building, the people in that column move through their Tuesday the same way, clocking in, doing their jobs, going home, not knowing about the filing system behind the filing system. A number had been assigned to each of them. Not a performance score, not a salary figure, a net present value, the value of what they would be worth when they were gone. The thing about that number is this. It existed before they arrived. It was calculated, verified, filed, and forgotten by the time they sat down at their station. And it would still be there, somewhere in a system, long after they had moved on, long after anyone who wrote it had moved on, long after the consultants who designed it had moved on, waiting, patient, precise. That is how institutions think about people, not with cruelty, with arithmetic. For most of 2 decades, no law said they had to tell you, not in the richest country on earth.